Good day, ladies and gentlemen, and welcome to the Ppc Bee 3 Investor Call. All participants will be in listen-only mode. There will be an opportunity to ask questions later during the conference. If you should need assistance during the call, please signal an operator by pressing star and then 0. Please note that this call is being recorded. I would now like to turn the conference over to Anashwin Pillay. Please go ahead, sir.
Yes. Good morning, everybody. Thank you for joining us on this call. We are quite pleased and excited to announce our BE3 named Ppc Pakama transaction. We have on the call from our side, we have Johan Claassen, our CEO. We have Trifosa Ramano, our CFO, and we have Siboeng Intembu, who's been the lead on the transaction. So we'll give probably a brief introduction. We have uploaded a presentation to our website, which we may put in additional information as and required, depending on the questions that we get. And I'll hand over to Johan Claassen now, so he can give an introduction.
Good morning, everybody, from my side as well. And I'll be very quick with the introduction, and we can immediately go over afterwards on Q&A. And I just would like to again say that, reiterate what Anashwin has said, that we are very excited and proud to announce our Ppc Pakama transaction, because we believe that we demonstrate our long-term sustainable value creation. And I think another big item on it is that our employees will hold roughly 10% direct shareholding in our SA business. And I must really say, and I must also say that will be on equal shareholding per individual. And I would really like to say it's really my hope that this marks an opportunity to create value for our employees while we simultaneously grow PPC into a formidable company. Thank you, and I think if you want to shoot with questions, you are more than welcome.
Thank you, sir. If anyone would like to ask a question, please press star and then 1 on your touchtone phone. If you wish to withdraw the question, please press star and then 2 to remove yourself from the question queue. If anyone would like to ask a question, please press star and then 1. Our first question is from Rowan Gula of Macquarie.
Morning, all. Thanks for the call. Just a question on the BE staff shareholding. Why are executive management included there? Surely you have shares through other means. What is the intention of that? Has it got some sort of symbolic intention? Otherwise, it doesn't really make sense. And the second thing is, why should you guys be rewarded for a black empowerment scheme, which has to be done anyway, and arguably has been done a little bit late?
Should we answer? Hi, Rowan, it's Trifosa. We've gone through this process at length with DMR, and DMR highlighted to us that employees must be treated equally. Whether you are an executive or you are white or you are in whatever manner, you must treat them equally. And the condonation they will make is that the law doesn't even allow white employees to participate, but they will make a condonation for that as long as all the employees participate equally. So that's basically that we could not remove whether you are an executive or not, and that is why the allocation per employee is probably around 300,000 rand per person, of which it benefits mostly the lower people on the ground.
So that's a DMR, is it a requirement or?
It's DMR requirement.
DMR requirement. And you get the full BEE credentials for that full stake, then is it 100% counted as 100% BEE?
Yes.
Yeah.
They won't give you like 80% of our staff, eligible staff, is black, and they won't do 80% of that. They will just give us 100% because they believe that the laws of the countries deal with how you treat your employees, and as a regulator, they cannot determine how you should treat your employees. We must just make sure we do not discriminate, because they do not want to be seen as a discriminator. So, but if we choose then to discriminate, then we must discriminate in terms of the law, whereby you apply your employment equity principles and you exclude anyone who is not black on the transaction. And for us as management, we also believe that if you have to go that route, then you are also going to create climate issues around all your employees.
And I think I would just add that's why it's allocated equally.
So everybody gets the same allocation?
Yeah.
Absolutely the same allocation. There's no differentiation in terms of your level in the company whatsoever. Everybody's got exactly the same.
Okay. Next question, how close were you to the DME actually taking action against you for being non-compliant? Well, firstly, how long have you been non-compliant? I just want to confirm that against the MPRDA.
Okay, Rowan, we've been non-compliant since we did the rights offer.
September 2016.
And then in the circular of the rights offer, we did indicate that the rights offer will make us non-compliant, but we are engaging with the DMR, and then we will come with a plan in terms of compliance. But the DMR has given us notice to say March is the D-Day. If we don't do anything by March, then they are entitled to put our rights in the website.
Ronan, I think
it looks like you've left a bit late. Can you give me the confidence that you've been a fairly reactive management team for the last 2 years for various things that have happened to the business, which has largely been, I think, a negative factor for shareholders because it's resulted in various things. This again looks like a reactive move. You're putting a BE deal in place at the last minute that could have serious consequences for the company. Can you just maybe give us any form of comfort that this is a well-planned, well-thought-out process as opposed to a bit of a knee-jerk reaction to possibly the DMR coming in and getting serious about deadlines?
Rowan, I think we can quite safely say that it's a process that has started after the rights issue. So we've been busy with it for the past 18 months. This 31st of March was the due date that we've put out quite some time ago already. So we haven't deviated from that. So it may look to the outside that it's in nick of time, but I think it was a very well thought through process. It is not a simple scheme. So there a lot of thought went into the scheme and how to put it together. And I think what we also just should spare a thought for, that we had the corporate action with us for quite some time during the same 18 months. So the corporate action surely had some distraction in terms of that. I don't want to use it as an excuse whatsoever, but it did.
And then Rowan, Nedbank was appointed in 2016, even before the rights offer, because at that time we knew BE1 was going to expire in December, and we were trying to put the process on the compliance in there. So they've been working on this transaction since 2016, but because we had all these disturbances with the corporate action and we couldn't actually push the BEE because it was going to be looked as a frustrating transaction. Then we went to the TRP to ask for permission because, as you are aware, one of those bidders who were bidding for the company indicated that there's no need for us to do any BEE because they are coming up with BEE credentials. So we had to submit to the TRP to say we were already far off in terms of the transaction, and we wanted to actually engage the shareholders by then to try and share what exactly we are doing on the BEE and try and pick up whether they can provide some inputs or not. Then it took a while, then the TRP says because of they can prove that you started this transaction before you had some approaches, it cannot be a frustrating transaction. Then we started working on it in the background. But while we were doing the corporate action, we couldn't even engage to say these are the structures that we are trying to put in. That is why you saw in December, once the corporate action was put out, we put those transaction terms to highlight, to say this is a BE that we are doing, we are putting a cautionary, and as a result, the deadline, it will be March, because already transaction documents and all of those things were done, and that is why we ended up with where we are. And then when we went to the DMR, that's when the DMR says, you've been postponing this thing for quite some time because of, we understand your corporate action, but we are a regulator, we deal with compliance. If you are not compliant, you are not compliant. So we give you up until the end of March. We can't give you any extension anymore because otherwise we will be forced to do it to other companies, which we are not. So that's basically the background.
Okay, thank you. That covers my questions.
Our next question is from Ilham Ismail of Prudential.
Hi, good morning. It's actually Chris Wood here from Prudential. I just want to clarify in paragraph 9 of the SENS release, you referred to the intrinsic equity value of PPC South Africa equaling 10.17 billion. If one were to gross up the 2.148 billion for the proportion that's being allocated, you get to an equity value of 8.456. I'm just trying to understand, when you refer to the intrinsic equity value, are you referring to the enterprise value, or is that the discount that's being applied for the BE? So there's about a 17% discount between the 10.17 and the 8.45.
Okay. So Chris, it's Anesh here. So the 10.1 is an equity value. I'll make it clear, it's an equity value, so it's after debt. So your enterprise value plus your debt to get to your equity value. And then there's non-controlling interest as well as marketability discounts taken into account. That's how you get to
despite what we were told, there is a BEE discount of some sort, which appears to be quite large, and then over and above that, we've got a notional funding rate of 7.75, which is incredibly generous, considering that the South African government can't even borrow money at that rate.
Chris, from the beginning, the valuation methodology that was adopted, and then KPMG did that, was that the value of the company on a 100% controlling basis is 10.1 billion.
Okay.
Then they say, because you are going to have a minorities and it's not non-controlling. So minorities and non-controlling, they use the PwC guidance, that one of non-controlling and minorities. I think minorities was 5 or non-controlling was 10. All of it ended up with, I think, 17%, if I'm not mistaken, as a discount for having your minorities and non-controlling. And says the value of the minorities and the non-controlling must be less that discount. And that is the value of the transaction. And then the same valuation methodology is going to be used at the exit as well, whereby the same methodology that you used at the beginning and you use it at the end.
Okay. No, thank you. Thanks for the clarification. Can I just understand, why is the 7.75 fixed funding rate not disclosed in the SENS announcement?
So, Chris, it was an oversight on our side, but it's in the fairness opinion, which should be loaded on our website. So it's an oversight on our part.
It is in the presentation slides from what we can see. So it's not that
it's an oversight. I think it's just an oversight. So apologies from our side.
No problem. And Chris, it's in the fairness opinion as well.
Yeah.
Okay. Thanks. Sorry, Ilham's just got a question while we're on the line. If you could is there an indication of a timeline, or is there a deadline by which the black entrepreneurs need to be identified and allocated their share?
Basically, with the board, we are discussing the process. We already had started with the process, and then what the board indicated is that from a strategy point of view, we need to have a process that is very defendable, that meets the requirements of what we want to achieve. And also it has to be entrepreneurs that add value to the business. So as a result of that, we had to go back to the drawing board, and we are engaging. So I think this process, per the discussion with the DMR, because they are also pressing us on that, we said they must give us up until the end of the calendar year for us to come up with a much more process that is defendable and credible and that will be palatable to everybody. We are not in a rush to fill up that box. But they will give us the 100% credit of that box.
Okay. So thanks very much.
Thank you.
Our next question is from Lonwabu Makubela of Petra.
Hi, good morning, everyone. I just wanted to ask on the intrinsic value applied to PPCSA, the 10 billion. What are the, I guess, assumptions that underpin that valuation? I understand the minority discount applied to that, but I guess in addition, just to get to the 10 billion, what are the underlying assumptions? Thank you.
Lonobo, the underlying assumptions without crossing the line of giving a profit focus is based on the business plan per individual business unit, and it was based on the sum of the parts valuation. So each and every business unit was valued on a discounted cash flow over the planning period of over 7 years, and some terminal values were also used in there, and then a discount rate was also used. And the discount rate is calculated by your KPMG. It's their own independently calculated discount rate because of the value that we wanted to come up with. It should be the value that should not be debatable by the or be in dispute by the participants, and we're going to use the same methodology at the end of the transaction, whereby there's supposed to be like a repurchase at the time of those particular sort of shares. So that's basically what we have done. And
then maybe another way. Sorry, maybe another way to ask would be, what comfort can we have? I guess because the margins in PPCSA are extremely depressed right now, and so what comfort can we have that I guess that it's not being taken at a very penal point in time.
Maybe I can answer that for you. In our business plan, we did plan for selling price increases, and you may recall that some time ago we said that we have adopted a value-based management methodology, and you also may recall that we said we are not currently making our cost of capital. So the long-term plan do include price increases and cost savings to reach our cost of capital. So remember we said that 50 rand per ton cost savings. Okay, so all that was included in our long-term plan to, in the end, make our cost of capital. So that has been included. I mean, so we have increased our profitability in a nutshell over the period.
Okay, but I guess your underlying premise is that that the business meets its cost of capital, which is quite. I guess I would say if we looked out in 5 years' time and the business only met its cost of capital, I think we'd all be disappointed. So it seems like quite a generous assumption to make.
I mean, dare I say that our plan is to improve our profitability significantly, and as a matter of fact, exceed our cost of capital.
And I think, Lonobo, that's basically what we have put in together as value-based management principles that we have implemented towards the end of last year, whereby each and every business does their business plan to make sure that they exceed the cost of capital. So we're using your CFROI model, and I think it's for the first time that PPC entities have actually adopted that. It was adopted long time ago, I think in the 90s. That's when you saw PPC's margins improved, and then it was abandoned, I think, in the early 2000s in there, because I think it created some issues. But now everybody's familiar with it. We reintroduced it, and people are comfortable with it. But then it forces the business to actually plan to make sure that they beat the CFROI, your cost of capital. So that's basically how the business plan has actually been done. And in those margins on a South African sort of business, despite the tough environment, you are having now a new entrant, which is your Osho is coming into the PE. And we are having CIF, which is coming in Mozambique, which is going to push some of the competition into the inland. So what we've done, we put in efficiencies with SK9 coming in. That 50 rand per ton, actually, we're going to exceed it in our business planning sort of a horizon. So the margins that are at the terminal are not the same lower margins as you have currently where we are on South Africa, are the improving sort of a margin in the business, which will be in a sustainable sort of level.
Yeah, I can maybe add on to that very quickly that we have planned for margins in the business of between 26 and 32% on the EBITDA level through the cycles, and if we run in that range, then we should meet and exceed our cost of capital, and the business profitability will be very marked increased.
Okay, thank you.
Our next question is from Murray Connellan of HSBC.
Hi, good morning, everyone. Could you please just confirm, first up, that there isn't really an upfront cash impact from this transaction, that effectively these shares are being given away at day one, and then with regards to the repurchase in 10 years' time, will that effectively be done at a fair market value as determined then?
So the only cash impact at the beginning at the inception of the scheme will be, as we said, in the sense that we will, for the lack of a better word, donate the shares to the schemes at 0.1 cent, and that 0.1 cent equates to roughly 1.2 million rand, and that's the only cash impact.
Transaction cost.
Yeah, so yeah, I suppose there will be a little bit of transaction cost, but that's the total sum of the cash impact.
All right, and could you maybe tell us what those transaction costs will be?
The transaction costs are estimated at cumulatively 20 million, of which some of them have been incurred from 2016 and 2017.
All right, and then the rate at which you expect to buy these shares back in 10 years' time, is that going to be at a fair market rate? How do dividends impact that over the course of the next 10 years? Maybe just a bit more guidance there, if you wouldn't mind.
I think from a dividend point of view, it will be when the company declares a dividend. 80% of the dividend is notionally supposed to be used to settle the notional funding. However, because it's notional, it's not in the balance sheet, so it actually goes back to the company to distribute to its other shareholders. In this case, it's PPC Limited. For example, if it's 100% of the dividend and the 25% participate in the 20%, effectively they get 5%, and the other portion of that goes back to PPC shareholders. So the PPC shareholders get 95% of the dividends that are declared as opposed to 75% up until the scheme unwinds in 10 years' time, with the exception of the communities, which that one is more of a perpetual sort of nature. So that is how it is structured. If there is any capitalization shares or there is dividend in specie, the BE participant don't participate. It goes 100% of the dividend in specie or capitalization goes to PPC Limited, which is the shareholder. And then at the end of the transaction, the formula gets adjusted for that in terms of the repurchase. That's effectively how it is done. And the idea is to ensure that you don't just declare a dividend at the RSA holdings if you are not declaring a dividend at the limited sort of level. It's supposed to be aligned because the holding company, which is a listed entity, its own cash requirement is only to deal with administrative issues, which can be dealt with in an intercompany loan point of view, or alternatively, if they need to do an acquisition outside of South Africa or outside of the PPC holding sort of a company, that's when they will need that sort of a bigger sort of a dividend in that aspect. So the way we're going to manage it internally, we're going to manage it in such a way that it doesn't create a disjoint or misalignment between PPC listed companies, shareholders, and the BE participants.
What's the rationale for buying back the shares that you've essentially given away for free in 10 years' time, rather than just having all three vehicles being perpetual in the same way that the community trust is?
The reason why DMR actually doesn't like the perpetual one, okay? They on the communities, they are happy for that, because the communities, for them, they believe that receiving a stream of income is palatable because they're closer to your operations. Employees, from a tax point of view, you must have an exit, because the tax doesn't differentiate between whether it's BE or not. The fact that you are related to your employees, from a tax point of view, as long as it's your share, Section 8 of the Income Tax Act applies. And then as a result of that, you need to have an exit. They treat it as if it's a share option scheme. So you need to have an exit, okay? And then for your entrepreneurs as well, from a DMR point of view, they also indicated you must have an exit. Initially, when we started, remember the first BE was done on an 8-year basis, and then the second BE was done on a 7-year basis. So we chose to extend this to about 10 years because we said to the DMR, we are a long-term business, and we can't continue to do a BE every 7 years or every 8 years. So we need shareholders that will actually be investing with us for a long term. Obviously, employees, they are long term for the business, although they come and go. There's a way the trustee deals with those that go. If they choose to go on their own, the shares goes back to the company, and then if they leave due to retrenchment, we call it good leavers. There's a formula that we use in calculating what needs to go to the employees in there. So we have the mechanism around it. So that's the rationale in terms of having your perpetual and at the same time having an exit. Initially, we wanted the employees to be perpetual because we said it's a long term, it's aligned. And then the tax advice we received is that you're going to have to fund the employees in terms of the mismatch of the tax event that actually occurs, because SARS will assume the tax event happens every year.
All right, thanks. And then just, sorry, one last follow-up from the question that Rowan asked earlier with regards to employee participation and the fact that it's and you mentioned the fact that it's going to be equally weighted on an employee-by-employee basis. Does that apply to directors as well? I'm just referring to Section 5 of the SENS announcement that says that director ownership or director participation in this trust may be greater than 0.25%, but no greater than 5% of the value of the transaction, I think it says.
Yeah, let me give context. Firstly, the estimation of your employees in South Africa is about 2.5. 9.8% times the value of your whatever the 8.5 billion of the business divided by 2.5 employees. That's equal allocation to everyone. Okay? So there is no differentiation between what your hand receives and what a truck driver receives in the company. It's all the same. Then secondly, that statement that talks about the small related party, because at the beginning when we were doing the black entrepreneurs, as part of the process, the strategic business partners who are part of BE1 and BE2 were also invited to participate in the process as per the requirement of the board. And then because we had 2 directors on the board, and when you looked in terms of if we were going to allocate, we use an assumption that if they get 1%, what will that be? And then it created a related party sort of a transaction, and we said, let's be on the safe side. As a small related party transaction, let's go to the JSE, and then let's get the fairness opinion. And that's the reason. So when we say it may be in excess, it's taking that into account. However, if they are not taken into account, there is no small related party, because myself and Johan, our allocation will be 600,000 rand.
All in all, yeah.
So that's effectively, that's effectively why you got to that level.
All right, thanks a lot.
Our next question is from Lazarus Shikweda of Investec.
Hi, thank you very much. Actually, the management did partially answer my question. It was more around the identification of black entrepreneurs. I wasn't aware that it was still an ongoing process. So what I wanted to find out was the criteria to be, I guess, which was used, or rather to be used to identify those individuals. And then the other question I actually had was around the fact that this BE scheme is being vendor financed at attractive rates, and effectively the BE beneficiaries will have full voting rights. Is there, what's the consideration behind that effectively, and why this sort of transaction wasn't brought to shareholders to vote on it? Thanks.
Thank you, Lazarus. I'll respond on the criteria for black entrepreneurs, and then Anashul and Johan will respond to the rest. So in terms of the criteria that initially have been set and shared with the DMR, we were looking for, what do they call it, the groups, the previously disadvantaged groups, which is women and youth, and then new entrants. And then the new entrants, we were actually looking for the ones that are participating in the downstream of our businesses. For example, they are in the same related business as our sort of customers, not necessarily customers, but construction and all of that. They're in the same industry, but on an operational sort of level. So those were the things that we looked into, and there was a full detailed analysis, due diligence that was done. Our advisors were actually running with that process. But I think with the board, they because they had the corporate action, we had the whole of, they believe that they did not apply their minds in detail with regard to that category. And that's why we were uncomfortable to choose from the list and saying these are going to be our partners. So the board requested to be given enough time to vet it again, so that as shareholders, when the shareholders ask questions, then they can be able to say, we have ticked and we are comfortable in that aspect. Then we went to the DMR, we requested them that if we do this BE without having chosen the partners for now, we are not going to be in trouble. And DMR was quite comfortable that tick everything according to how you should be, as long as your intention, we know what your intention is good intention, you want to comply, and that is why they could condone us for 18 months without complying, working with us. So that's basically the background in terms of that particular aspect of the black entrepreneurs. So we are warehousing that 7.6%. You want to answer that?
Lazarus, just repeat your other question.
Relating to I think the other question was around equal voting rights for BE shareholders, despite the fact that they're being vendor financed by effectively the company at the.
In terms of all the BE schemes, I think what you look into in terms of the law, it must be the economic right. So for the law in terms of MRDP, is that voting is very crucial. And that is why even though it's that call option, but it must not vote differently from the other shareholders in terms of the law. In B1 and B2, it's exactly like that. If you look at most of the notional vendor funding, they're actually done like that. Because the law is very prescriptive.
Thank you.
Our next question is from Chris Reddy of Marzi Capital.
Hi, good morning, everyone. Thanks for your time. I've got a question which was partly answered by Trafosa earlier in a response to another question on the dividend. If I just go to the 25.4% that's held by the Empowerment Consortium in PPC SA, are you able to tell me what was that quantum in last year's financials? I get your point, Trafosa, to say that it's only a 5% leakage because 80% still goes through to PPC Limited shareholders. But are you able to just quantify what that dividend was in 17's numbers?
We don't have the number because remember we only started having PPC South Africa last year because in the past we didn't have a South African holding company. Everything was held through PPC listed company, and then that's why we had a lot of tax leakages. And then when DMR was challenging us even on our BE at the LISCO to say they don't care about our international operations, the law talks about 26%. So that means we were supposed to just do 26% at the top of 100% of PPC LISCO, which then was effectively 35 or whatever. 40% of the South African holding. So when we restructured the company, it took longer to do that. But I think April last year, that's when we have swapped down all the assets and put them in there. And then that's when we started doing the operations in there. So that's effectively is still new from the operations.
So if you have to calculate it based on interim numbers, what is the size of that 5% that goes to the BE? If you have to calculate it based on interim, let's just say 6 month numbers since it's been in existence, what would be the size of that 5%?
No, we don't put then policy around that because we wanted to make it flexible because we did not want to hardwire it so that you find that there's expectation. So if there's a year we believe that you don't have to declare the dividend, we don't declare a dividend. So that's basically what we've done.
Okay, and just to confirm, PPC SA won't declare a dividend won't distribute a dividend to the parent unless Limited also starts paying a dividend.
The intention is to have it that way.
Yeah. Okay. Got it. Thanks.
Is to align the shareholders and all the other shareholders, unless tax at some stage dictates that it's prudent to do it in that manner. But we will explain it to shareholders if it changes. But the intention from management is to make sure that when you decide to declare dividends to shareholders at Limited, the only way for the shareholders at Limited to get the dividends is to declare the dividends as South African operations.
Okay, understood.
Our next question is from Yusuf Maulana of Allan Gray.
Hi guys, thanks for the call. I'm sorry if I missed it, but I understand the finance cost to be 7.75%. Can you advise how that compares to PPC's kind of borrowing rates over 10 years? And also if you know what the thoughts were on maintaining, achieving that or arriving at that financing cost. just with regard to what you think kind of a fair return is for shareholders for funding this deal. Thank you.
I think we've answered that before. The key, we linked it to the SARS rate, and the SARS rate is linked to your employees for fringe benefit tax. Okay, that's the rationale around that. And because from a tax point of view and from any other thing, this is not a debt per se. And when we engage with the DMR actually wanted us to have even a lower rate. We fought for the lower rate. We said you can't have any rate that is lower than your tax rate, because then you are creating a tax event for employees on a monthly basis, basically, in that aspect. And in conceptualizing it with the DMR, then they ended up saying then what you could do then, link it to your sales rate, the way you've done it with the previous BE. The previous BE that we've done, BE2, is exactly the same. It hasn't changed. It was linked to the SARS rate purely because we've got an employee sort of element. And the cost of debt on the long term for PPC side on the RSA basis is effectively 9%.
Thank you.
Our next question is from Tinashe Kambadza of AfriFocus.
Good morning, guys. Thank you very much for the call. Most of my questions have been asked, but I'll just touch and go. I think the first one that I want to just get clarity on, which is more of from a corporate governance perspective, and I think I asked this question before. Obviously, there were issues arising from whether this was going to be put to a shareholder vote or not, and then obviously the fairness opinion came through from KPMG. So, I mean, from my perspective, just given the fact that, and I keep saying from a corporate governance perspective, given the fact that KPMG obviously is independent experts, and with some of the assumptions underlying the valuations on the PPCSA business, and given the fact that the reputation has come under a bit of scrutiny, and my understanding is that there might be a report which might be coming out in March or maybe in the next month or two, which might place, the KPMG brand under more scrutiny. I just want to understand and get a feel from management's perspective, how, comfortable are you guys having used KPMG as the independent expert? And in doing the valuation, was there any consideration to use another independent expert? Because if more scrutiny comes through, then it might actually question some of the underlying assumptions, which pretty much form the basis of this whole BEE transaction. So from my perspective, I'd like to get a better understanding of where management stands on that.
I think on the KPMG, we don't want to comment about people's brands. Probably you have information that we don't have. I mean, it's the same as the cartels in South Africa, all the construction companies that came under scrutiny. People still do business with them. And the cement industry was also attacked on the cartel. Their brand came under attack, but people still do business with them on that. So I think the philosophy that we did as a board, they considered the team that we worked with in the KPMG were very thorough, very professionals with a great experience. We understand the challenges that they went through. And as management, we also did the evaluations ourselves, although we differ from the discount rates that they have actually used, because it's a professional judgment. And when we also have a corporate action, we also did your sum of the parts, which was done by Investec. So we take comfort from the methodology that actually has been used, that we can actually vet it. Even if you use another independent evaluator, they can be able to come up with the more or less the same sort of valuation. Again, as we said, we are doing a value-based management principles in terms of how we look at our companies. We have employed a company. What is what is it? Fractal Capital, which has got professionals who are specialized in the CFOI model, and when they are doing the CFOIs using the same data points, they come to more or less same value, obviously, depending on discount rate, the value is very sensitive. So we're quite comfortable that on that aspect we really have ticked all the others, but we cannot comment about KPMG.
Okay, fair enough. Just in terms of the discount rates, because you're saying that those differed somewhat. Was there a major difference, and was there much any other major differences between the valuation that you guys had and that came through from the independent experts?
So there's not much of big differences. Obviously, from a discount rate, they use their own, and we have our own cost of capital. We did announce that our real cost of capital is 8%. And that's on a real sort of basis. That's what we actually need to beat in terms of creating shareholder value. They use a different rate and they justify. We also ask PwC to do the cost of capital calculation just to compare, and they are also different. But it's more or less the same methodology. Is basically your judgmental call that you actually use. And then even when you talk to Fractal Capital, they say, you know the business much better than anybody else. So you know how much this business costs from a cost of capital, and we have calculated from that aspect. So because of the nature of the business and your free cash flows, your cost of capital is very sensitive to your value.
And multiples is from the
And also you use your indicative EV to EBITDA multiple.
Yeah. So if you do a EV calculation, if you work back the data to an EV, it's a fairly fair multiple. But and also bear in mind, it's not cement alone. There is lime and aggregates and things like that in there as well. So I suggest do a check for yourself.
And then from the governance point of view, when we started this in 2016. Management intention was always to go to the shareholders, even though the regulation did not allow us to, the JSE listing, it was never a requirement. So we were intending to actually make sure that we, as a good guide, we want to go to the shareholders. But the corporate action, I don't want to lie, how much management time the thing has taken. It really drained the management team in the company, and there was no way anyone could actually focus on putting a circular together to try and have the BE. At the same time, we were worried about protecting the rights of this company. When you receive a letter from DMR saying, we are not going to tell you when we are going to put your rights on the website, you gave us your timeline, and these are the timelines that you've been extending and extending. So we were in that middle while the board is entertaining this. Management wants to run the business. It was really a difficult period, honestly speaking. I have to say, I don't know your hand wants to add. It was a difficult period for us.
I agree.
One last question. I think you did mention that obviously interacting and working with the DMR, you guys have been non-compliant since 2016 September. So there haven't been any costs that have come through because of the non-compliance. Am I right to assume that?
No, there is no cost on the DMR, but there is a cost in the business. Because remember we restructured the business. The mineral rights are sitting at the top, which is at the listed entity. And then the compliance has to happen at the entity level. So DMR, your mineral rights need to reside in the companies that are doing the mining operations. So they have condoned us on that because they know we have applied for Section 11 to transfer them. And they said the approval of Section 11 is conditional on you complying to the BEE. Then in terms of the tax law, we are supposed to claim diesel rebates because we do mining operations. So normally for your diesel, when you have your trucks transporting whatever the limestone from dumping site to the crusher, whatever, we claim that. There is a cost of 20 million that PPC is not claiming because the mineral rights reside somewhere and the operations are somewhere. So we can't claim that rebate, and that is a cash cost for the business. And there is also your on the sales side, we've been losing some of the contracts from our customers that are saying they need us to comply with the DTI, and the DTI wants us to the ownership element is also very crucial. So that's effectively some of those implicit costs that you can put it. And that is why even KPMG, when they did the fairness opinion, they took all of those things into account and say, if you guys don't comply, you don't have a business, basically. Okay?
Yes.
And shareholders are going to blame you. And I said, we've been working for 18 months. And that is why we ended up had to say to the board, last year in December, we cannot wait anymore. Corporate action or no corporate action, we need to start talking to the shareholder about this transaction. Because tomorrow, when you have been put on notice, shareholders are going to say, management, you are reactionary. Whereby management has been working on this thing for 18 months.
Yeah. So we are also engaged with our customers. And we have told our customers, obviously, that the transaction is or the design of the transaction is in progress, and that we should be done by 31st of March. So with that in place, they sort of didn't penalize us too much, but obviously they inquired because they can buy from others. I mean, manufacturers that do comply.
Okay.
So it's a quite a big thing now. It's not a trivial thing whatsoever.
And I think we can give you assurance that, to be honest, GMR have worked with us on this path. Yeah. It was a very difficult path, but they say, we understand, we know your intention is to do the right thing, okay? So I think where they end up becoming disappointed is because we kept on extending the timeline. It was we were supposed to do this thing last year in June, and then we had this corporate action, and we kept on extending and extending and extending. It was in December whereby I think as management we said to the board, we cannot continue anymore. We must just announce at least the salient terms and start talking to the market, because tomorrow, when there's trouble, it's going to be management.
No, fair enough. So just based on what you just recently said, I mean, it's now, cast in stone that 31st of March, you're going to implement this thing. Like, so we shouldn't be assuming that there might be further costs if it creeps beyond the 31st of March, because that's not gonna happen. Cast in stone 31st of March, you're gonna implement it, essentially.
No, 31st of March, we are submitting transaction agreements to the GMR.
Okay. All right. I think that's it for now. Thanks. Thank you.
And also remember, the NVF transaction is very flexible. Maybe if let's say you go further down a year or two, and shareholders are still adamant, they are not happy with certain aspects, the company can actually amend some of those with the right justification. So it's structured in such a way that is very, very flexible. And then you can actually explain it to the DMR if you want to do some sort of amendment on the NVF.
Okay. But wouldn't that be, sorry to just keep going on, but wouldn't that, such a situation that you just explained, wouldn't that be a tougher ask with your client? Because, I mean, the DMR potentially, given the fact that, they know your intentions from a transformation perspective, but then with clients, wouldn't that open up more risk, given that they can actually go and, acquire the products they need from your competitors in the market? So surely you wouldn't want that scenario. I think that's
no, you don't want that scenario. I'm just saying you first comply, and then after you comply, you have nice conversation. So you can't have nice conversation if you're not compliant. That's where the issue is.
Yeah. Okay. All right. Yeah. Okay. No, thank you very much. That's it for me.
We have a follow-up question from Rowan.
Thanks, guys. I just wanted to come back to the timing one last time. If you decided to go for shareholder approval, would you have been able to get the transaction done before the 31st of March? So really, was non-compliance and the risk associated with that a consideration in not asking for shareholder approval?
So if we were going to do shareholder approval last year, in terms of our timetable, probably this thing could have been put to the shareholders around June, July, or August, okay? But the corporate action and the TRP process and whatever actually took that away. Yeah. Because what you need to do to put to shareholders, you need to put circulars, you need independent experts, you need Can they still hear me?
Yeah.
We'll need all of those sort of information. The corporate action, to be honest with you, is the one that has actually sidetracked us from a management point of view, because you had to deal with the issue of the corporate action, you had to deal with the issue, and it's the same team that has to prepare the information. Remember, you have your finance department, you have your auditors that need to sign off on those. You have a corporate action. The DDs are happening. It's the very same information of people that are supposed to provide the info. That's where we were actually last year. It was not a nice period to actually be. It's a practicality.
Thank you.
Ladies and gentlemen, just a final reminder, if anyone would like to ask a question, please press star and then 1. We will pause a moment to see if we have any further questions. So it seems we have no further questions on the lines. Would you like to make any closing comments?
I would like to do. I would just like to tell compliment my team here, Barbosa and Severin, for all the work that they have done over the past 18 months. And I think, as Barbosa have explained quite well up to now, it was a bit of a tough time. So I think it's probably appropriate to say to them, well, very well done. Before we finally close, I would just like to say, really, the BE3 transaction, or Ppc Pakama, is really a business imperative. We just have to do it to ensure that we comply with the laws of the country, and we really think that it's an opportunity for us to build lasting relationship with our employees. Our employees, after all, is the individuals that contribute to the wellness of the business. So it is the right thing to do, and we have to move forward, although it took quite a while for us to implement it.
And then I think the other thing that I forgot to mention, remember, while we were working on this, you had the mining charter, the new mining charter, which was actually introduced.
Yeah.
And it also at that time, we actually seek legal opinion to say, can we really interdict or ask DMR not to say we are non-compliant because there is this pending charter which is under sort of dispute. And the opinion came in to say your non-compliance got nothing to do with the law. It's because of you had to do your rights offer and your B1 expired.
Yeah.
So as a result, you're not going to win on this case. The best thing is to join the chamber and be a participant in the bigger case with the chamber. But you stand a less chance because other people are compliant within the chamber. So we've looked at all of these issues also internally, because our key concern was the dilution to the shareholders, and the shareholders have walked the path during difficult times in this company. So we also looked into that other aspect as well.
We were non-compliant with the current legislation. Okay, from our side, thank you very much for calling in. And I'll give to Anesh quickly.
Yeah, so thank you, everybody. As always, if you have queries and questions, I'm sure you'll take a little bit of time to digest things. And as I said, the presentation that we put on the website will be kind of a living kind of document, and we'll add things as we get Q&As and things like that. We'll try and update you, but as always, you can send me emails and we can deal with it that way. Okay, thank you.
Thank you.
Thank you.
Ladies and gentlemen, that concludes today's conference. Thank you for joining us. You may now disconnect your lines.